Hello everyone and welcome to our lesson on the complete guide to Japanese candlesticks. This is a really important lesson and you should follow it to the very end. As a bonus, we have a special section on common mistakes that new traders make, so stick around to the end to catch the bonus. Japanese candlesticks have now become the default chart for Forex traders. When you use Japanese candlesticks, you will also spot familiar patterns, and traders use these to trade the markets. We will be showing some of the most important patterns in this lesson. Before we start the lesson, make sure you subscribe to the channel and hit the like button. We really appreciate your support. And if you have any questions, put them down in the comments below. We always read your comments. If you are looking for a highly profitable trading system, you should head over to our website, smartforextrading.com. Over 90,000 traders use the Smart Forex Trading system. If you are struggling in your trading, you should start using the Smart Forex Trading system. Remember, once you have a profitable system, trading becomes easy. Make sure you like, subscribe, and turn on bell notifications. It really helps the channel to grow. Before we jump into the lesson, a quick disclaimer. Smart Forex Trading offer educational videos to help and educate Forex traders. Information on this channel is for educational purposes only and should not be considered financial advice. We must advise you Forex trading carries a high level of risk, and you should be aware of the risks before trading in Forex. Let's now start our lesson, Complete Guide to Japanese Candlesticks. Japanese candlestick charts are thought to have been developed in the 18th century by Munehisa Homma, a Japanese rice trader. They were commonly used to show the daily price movements in the Japanese rice market. They were introduced to the Western traders by Steve Nison in his book Japanese Candlestick Charting Techniques, first published in 1991. Japanese candlesticks are the most widely charts used in Forex trading. It is essential you understand how candlesticks are formed and how to spot common candlestick patterns. Japanese candlesticks can be used for any time frame, whether it be 1 day, 1 hour, 30 minutes, 5 minutes or 1 minute charts. They are used to describe the price action during any given time frame. Japanese candlesticks are formed using the open, high, low, and close of the chosen time period. If the close is above the open, then a bullish candlestick is drawn. These candlesticks are normally displayed as a green candlestick. If the close is below the open, bearish candlestick is drawn. These candlesticks are normally displayed as a red candlestick. The filled section of the candlestick is called the body. The thin lines poking above and below the body display the high/low range and are called wicks or shadows. The top of the upper shadow is the high. The bottom of the lower shadow is the low. Japanese candlesticks have different body sizes. Long bodies indicate strong buying or selling. The longer the body is, the more intense the buying or selling pressure. This means that either buyers or sellers were stronger and took control. Short bodies imply very little buying or selling activity. Quick reminder for those that are not familiar with bulls and bears. In Forex trading language, bulls mean buyers and bears mean sellers. Long green Japanese candlesticks show strong buying pressure. The longer the white candlestick, the further the close is above the open. This indicates that prices increased considerably from open to close and buyers were strong. In other words, the bulls were in charge and there were very few bears in the market. Long red candlesticks show strong selling pressure. The longer the red Japanese candlestick, the further the close is below the open. This indicates that prices fell a great deal from the open and sellers were strong. In other words, the bears were in control of the market price. Wicks and shadows. The upper and lower shadows on Japanese candlesticks provide important information about the trading session. Upper wicks or shadows signify the session high. Lower wicks or shadows signify the session low. To make it a little easier, we will refer to wicks and shadows as simply shadows. Candlesticks with long shadows show that trading action occurred well past the open and close. Japanese candlesticks with short shadows indicate that most of the trading action was confined near the open and close. If a Japanese candlestick has a long upper shadow and short lower shadow, this means that there are strong buyers and pushed prices higher. But sellers came in and drove prices back down to end the session back near its open price. If a Japanese candlestick has a long lower shadow and short upper shadow, this means that sellers pushed the price lower, but buyers came in and drove prices back up to end the session back near its open price. Let us now look at common Japanese candlestick patterns. One of the best things about Japanese candlesticks is they form many patterns, and traders can use the pattern recognition to form trading ideas. The first pattern we will look at is spinning tops. Japanese candlesticks with a long upper shadow, long lower shadow, and small real bodies are called spinning tops. The color of the real body is not very important. The spinning top pattern indicates the indecision between the buyers and sellers. The small real body shows little movement from open to close, and the shadows indicate that both buyers and sellers were fighting, but nobody could gain the upper hand. Even though the session opened and closed with little change, prices moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand. If a spinning top forms during an uptrend, this usually means there aren't many buyers left and a possible reversal in direction could occur. If a spinning top forms during a downtrend, this usually means there aren't many sellers left and a possible reversal in direction could occur. The next pattern we will look at is called Marubozu. The word Marubozu translates to shaved head in Japanese. So a Marubozu candlestick is a shaved candle, means it has no shadow or wick. You can have a bullish Marubozu. This means that the candle opened at its lowest price and closed at its highest price. This is a very strong bullish candle, as it shows that buyers were in control of the entire session. It usually becomes the first part of a bullish price movement. You can also have a bearish Marubozu. This is a very bearish candle, as it shows that sellers control the price action the entire session. It usually implies bearish continuation or bearish reversal. Bullish Marubozu. If a bullish Marubozu forms at the end of an uptrend, a continuation is likely. If a bullish Marubozu forms at the end of a downtrend, a reversal is likely. Bearish Marubozu. If a bearish Marubozu forms at the end of a downtrend, a continuation is likely. If a bearish Marubozu forms at the end of an uptrend, a reversal is likely. A Doji candlestick is one of the most important Japanese candlestick patterns you need to learn. Doji candlesticks have the same open and close price, or at least their bodies are extremely short. A doji should have a very small body that appears as a thin line. Doji candles suggest indecision between buyers and sellers. Very often a doji simply means, wait for further confirmation. Prices move above and below the open price during the session, but close at or very near the open price. Neither buyers nor sellers were able to gain control. When a doji forms on your chart, pay special attention to the preceding candlesticks. If a doji forms after a series of bullish candlesticks, the doji signals that the buyers are becoming exhausted and a trend reversal can happen. If a doji forms after a series of bearish candlesticks, the doji signals that sellers are becoming exhausted. In order for the price to continue falling, more sellers are needed, but sellers are all exhausted and a trend reversal can happen. While the trend is weakening, further buying strength is required to confirm any reversal. Hopefully, by the end of this lesson on Japanese candlesticks, you will know how to recognize different types of candlestick patterns and make sound trading decisions based on them. Now that you're familiar with basic candlestick patterns like spinning tops, maos, and dojis, let's learn how to recognize single candlestick patterns. When these types of candlesticks appear on a chart, they can signal potential market reversals. Here are the 4 basic single Japanese candlestick patterns. Hammer and hanging man. The hammer and hanging man look exactly alike but have totally different meanings depending on past price action. Both have small bodies with long lower shadows, and short or absent upper shadows. The hammer is a bullish reversal pattern that forms during a downtrend. It is named because the market is hammering out a bottom. When the price is falling, hammers signal that the bottom is near and the price will start rising again. The long lower shadow indicates that sellers pushed prices lower, but buyers were able to overcome this selling pressure and closed near the open. Just because you see a hammer form in a downtrend doesn't mean you automatically place a buy order. More bullish confirmation is needed before it's safe to trade. Here are some tips on how to spot a hammer candlestick. The long shadow is about 2 or 3 times of the real body. Little or no upper shadow. The real body is at the upper end of the trading range. The hanging man is a bearish reversal pattern that can also mark a top or strong resistance level. When the price is rising, the formation of a hanging man indicates that sellers are beginning to outnumber buyers. The long lower shadow shows that sellers pushed prices lower during the session. Buyers were able to push the price back up some but only near the open. This should set off alarms, since this tells us that there are no buyers left to provide the necessary momentum to keep raising the price. Here are some tips on how to spot a hanging man candlestick. A long lower shadow which is about 2 or 3 times of the real body. Little or no upper shadow. The real body is at the upper end of the trading range. Inverted hammer. The inverted hammer occurs when the price has been falling, suggests the possibility of a reversal. Its long upper shadow shows that buyers tried to bid the price higher. However, sellers attempted to push the price back down. Since the sellers weren't able to close the price any lower, this is a good indication that everybody who wants to sell has already sold and buyers are now taking control. Shooting star. The shooting star is a bearish reversal pattern that looks identical to the inverted hammer but occurs when the price has been rising. Its shape indicates that the price opened at its low, rallied, but pulled back to the bottom. This means that buyers attempted to push the price up, but sellers came in and overpowered them. This is a definite bearish sign since there are no more buyers left because they've all been overpowered. Engulfing candles. There are 2 types of engulfing candles, bullish engulfing and bearish engulfing. The bullish engulfing pattern is a 2 candlestick reversal pattern that signals a strong up move may occur. It happens when a bearish candle is immediately followed by a larger bullish candle. This second candle engulfs the bearish candle. This means buyers are present in the market and that there could be a strong up move after a recent downtrend or a period of consolidation. On the other hand, the bearish engulfing pattern is the opposite of the bullish pattern. This type of candlestick pattern occurs when the bullish candle is immediately followed by a bearish candle that completely engulfs it. This means that sellers overpowered the buyers and that a strong move down could happen. Tweezer candlestick patterns are 2 candlestick reversal patterns. This type of candlestick pattern is usually spotted after an extended uptrend or downtrend, indicating that a reversal will soon occur. There are 2 types of tweezer patterns, the tweezer bottom and the tweezer top. The most effective tweezers have the following characteristics. The first candlestick is the same as the overall trend. If the price is moving up, then the first candle should be bullish. The second candlestick is opposite the overall trend. If the price is moving up, then the second candle should be bearish. The shadows of the candlesticks should be of near equal length. To identify triple Japanese candlestick patterns, you need to look for specific formations that consist of 3 candlesticks in total. These candlestick formations help traders determine how the price is likely to behave next. Some 3 candlestick patterns are reversal patterns, which signal the end of the current trend and the start of a new trend in the opposite direction. And other 3 candlestick patterns are continuation patterns, which signal a pause and then the continuation of the current trend. Let's take a look at 3 green soldiers and 3 red crows. The 3 green soldiers pattern is formed when 3 long bullish candles follow a downtrend, signaling a trend reversal has occurred. This type of triple candlestick pattern is considered as one of the most important bullish signals, especially when it occurs after an extended downtrend and a short period of consolidation. The first of the 3 soldiers is called the reversal candle. It either ends the downtrend or implies that the period of consolidation that followed the downtrend is over. For the 3 green soldiers pattern to be considered valid, the second candlestick should be bigger than the first candle's body. Also, the second candlestick should close near its high, leaving a small or non-existent upper wick. For the 3 green soldiers pattern to be completed, the last candlestick should be at least the same size as the second candle and have a small or no shadow. The 3 red crows candlestick pattern is just the opposite of the 3 green soldiers. It is formed when 3 bearish candles follow a strong uptrend, indicating that a trend reversal is likely. The second candle's body should be bigger than the first candle and should close at or very near its low. Finally, the third candle should be the same size or larger than the second candle's body with a very short or no lower shadow. For the 3 red crows pattern to be completed, the last candlestick should be at least the same size as the second candle and have a small or no shadow. We promised you a bonus, common mistakes that new traders often make when using Japanese candlesticks. 1. New traders try to find meaning in every candlestick that appears on the chart. A lot of the time, markets are noisy. Not every candlestick is useful when thinking about future price movements. Instead of looking at every candlestick, focus on the ones where the price is currently trading near important support and resistance levels. 2. You imagine candlestick patterns. If you have to zoom in 500% or squint at the Japanese candlestick chart because you think you see something, there's probably nothing there. You are just imagining candlestick patterns. Instead, you should focus on finding evidence of strong buying pressure when you expect to buy, and evidence of strong selling pressure when you expect selling. 3. Candlestick patterns are never exactly like textbook examples. Japanese candlestick patterns that are supposed to form after 3 candles based on textbook examples may actually end up forming over 4 or 5 candles. Just because a 3 candlestick pattern takes 4 candlesticks to form doesn't invalidate the pattern. The meaning is still the same. It's more important to understand the price action behind the candlestick pattern than to simply memorize its standard pattern. 4. You forget the forest from the trees. If you constantly just focus on shorter time frames like 5 minutes charts without stepping back and trying to look at the bigger picture, your trades will tend to get blindsided. Try not to make your focus too narrow and look at the bigger time frames for confirmation. 5. You don't wait for confirmation. There are some candlestick patterns that are considered self-confirming, but many are not. Make sure to wait until the candlestick closes and is fully formed before acting on a pattern. Always wait for the right confirmation that the price is moving in the direction you're expecting. Let us now review what we have learned about Japanese candlesticks in this lesson. If the close is above the open, then a bullish candlestick is drawn, usually displayed as green. If the close is below the open, then a bearish candlestick is drawn, usually displayed as red. The filled section of the candlestick is called the body. The thin lines poking above and below the body display the high-low range and are called wicks or shadows. The top of the upper wick or shadow is the high. The bottom of the lower wick or shadow is the low. Long bodies indicate strong buying or selling. The longer the body is, the more intense the buying or selling pressure. Short bodies imply very little buying or selling activity. Upper shadows signify the session high. Lower shadows signify the session low. We look forward to meeting you in the next lesson, and quickly, if you have not yet subscribed, help us out. Just hit the subscribe button now. We really appreciate your support. If you have any questions, please leave them in the comments section. We do read all your comments. And just a final reminder, if you have not yet checked out our website, head over there now and you will find one of the most profitable trading systems used by over 90,000 traders. Check it out now on smartforextrading.com. Thank you, and I look forward to seeing you in the next lesson. Help the channel to grow. Like, subscribe and turn on bell notifications. We hope you enjoyed the lesson, and we will see you on the next one.